There are lots of reasons to consider investing in or buying a business. Maybe you just like the area that the business is in. You feel that it's just personally important to you. Maybe you're buying yourself a job. Maybe it's a purely financial investment that you don't plan to involve yourself in much at all. Whatever the reason, make sure your reason for making this investment is clear, because the reason you make the investment is going to dictate the way that you pursue it in order to secure the best outcome possible. When people are buying or investing in a business for the first time, they're sometimes surprised by the difficulty in simply finding that business to buy or invest in the first place. There are lots of ways to find a business to invest in, sometimes over the internet. There are listings in companies such as bizbuysell.com. You can talk to your friends, you can talk to your neighbors, you can talk to your professional advisors. You might even find it useful to talk to investment bankers and business brokers to see which businesses they're representing in the marketplace at the present time. Once you identify that opportunity, the first step is due diligence, which is the process of examining a business to determine its strengths and weaknesses, as well as the opportunities and threats that are posed by its industry environment. This process is meant to identify and determine the risk level in the company, and you cannot make an effective investment without fully understanding the risk. The next step is to understand the business's value. You should understand the price that you're prepared to offer and/or the terms that you're going to accept. And you should have a clear understanding whether the price and terms under discussion are consistent with the market. The key to good due diligence and valuation is to ask lots of questions and get outside help, including law firms, valuation firms, accounting firms, and other expertise. In our experience, the most frequent mistakes that lead to a bad outcome for an investor or buyer of a business are: one, they don't do enough due diligence. And this is easy to do because due diligence is tedious, it's time-consuming, and can be expensive. It's very tempting to cut corners on due diligence. The problem is we see over and over again that the one place where somebody cuts a corner is the one place where the key vulnerability of the business lay and wound up being the reason that the business investment was not successful. The second reason a business purchase or investment fails is simply because the buyer or investor overpaid. Now, overpaying in and of itself is not necessarily the end of the world as long as you do it purposefully. There may be very good reasons you're going to overpay for a business. Maybe you're going to do it because there's a personal relationship involved. Maybe you're under time pressure to buy the business, or maybe there's something else involved. But understand at least why you're doing it. There's a saying in the transaction world that the return on a business is baked in the day that it's bought. And the reason for that lies in the valuation. The higher the valuation, the better the business has to perform in order to produce the required return. If you do overpay at the outset, then you're putting more pressure on the business to produce the return necessary to justify the risk that you're taking in entering into the transaction. Once you identify the business, you've carried out your due diligence, and you've determined the appropriate price to pay, next comes the negotiation phase. And this is where you need to make sure that both the price and the terms of purchase are going to be the right fit. And you may decide that it's worth paying a higher price in order to secure more favorable terms. For example, if you want the seller to finance a good chunk of the purchase price, you may need to, or indeed be very willing to pay a higher price to compensate the seller for that risk if it makes it financially more viable for you to pursue the transaction in the first place. Some of the key terms of an investment might be: are you getting control of the company, or are you buying a minority interest? Are you going to have board representation that gives you a say in the most important decisions of the company? Are you going to be able to participate in a drag along, meaning that if somebody else is able to sell their shares in the company and they get a good deal, can you jump on that deal as well? One real world example was we had a client that wanted to buy a business and roll it up into the business that he already owned. We performed a valuation to determine the appropriate price and help ascertain the risk in purchasing that business. And we spoke with the seller many times to obtain a better understanding of their priorities. We discovered that the seller wanted just to sell a business so they could raise cash in order to make an investment elsewhere. With that in mind, we were able to structure a deal where the acquisition was affordable and the seller was still happy because it was an all-cash deal. Our client likely paid less than they would have paid had the deal had a more complex structure. This put our client in a position to acquire more businesses down the road and is now positioned to sell the entire business for hundreds of millions of dollars. Buying or investing in a business has a lot of moving parts that can be confusing even to the most experienced business people. But we can help. If you want some assistance with understanding your opportunity and how to best pursue it, contact us to set up a free consultation.